We can start.
Good evening, members. On behalf of the SIRC of ICAI, I welcome you all for the Investor Awareness Program, Smart Investment in Capital Market. Before we start introduction of our eminent speaker, we would just like to highlight upon the 53rd Regional Conference of ICAI, which is to be held on 19th and 20th of November 21 at Lee Meridian, Coimbatore. We request all the members to register for this conference, which is both physical and virtual. During the course of this meeting, a link will be shared and you can register in either mode, either virtual or physical mode. Thanks, Mike. Coming back to the seminar, this is a virtual seminar on Investor Awareness Program. The topic of this session is Smart Investment in Capital Market. We have with us Sri D.S. Anantharaman, sir, from Tricur, Kerala. Anantharaman, sir, is a Bachelor in Commerce, a Chartered Accountant, completed in 1967 at the age of 19. And a member British Institute of Management. He has been awarded the Lifetime Achievement Award from School of Management Studies, University of Calicut, and Tricur Management Association. Management Excellent Award from Surya TV Tricur and the Chamber of Commerce of Tricur. Currently, Sir is the investment consultant with 30 years of experience in Indian capital markets and banking. He presently the chairman, Leo Pharma Group of Companies, Tricur, Director, Kalyan Jewellers Limited, Tricur Hospital Limited, Mobme Wireless Limited, Polyclinic Private Limited, Tricur. He is a member Academic Council of St. Thomas College, Autonomous, Tricur. He has authored the best-selling book, Stock Market Wisdom, published by Paxman, New Delhi. Previously, to go with the long list, I think he was the chairman of Catholic Syrian Branch, Tricur, for the year 2016-18 and member of Board of Directors from 2019 to 16. He was the founder, chairman, and managing director, Peninsular Capital Market Group of Companies. He was vice president, Cochin Stock Exchange for the year 92-94. He has been director of several listed companies, including Manappuram Finance, Eastern Threads, Motilal Oswal Financial Services, and Sri Shakti Paper Mills Limited. He has been in United Nations expert with International Labour Office, Switzerland, head of the Department of Accountancy and Management Studies, University of Botswana, assistant finance manager, National Housing Corporation, Tanzania in 1974-76, partner of a leading firm, Chartered Accountant, Tricur, from 69 to 74, and he was before that lecturer of management studies at St. Thomas College. To go with the list, the other activities, he was a president, chairman of Commerce of Tricur, member of Executive Committee, National Stock Exchange of India, Mumbai, General Secretary, All India Kerala Chemist and Druggist Association, nominated member of the Committee of Regional Council, Chennai, and Central Council of the Institute of ICAI of New Delhi. Advised various governments, Botswana, Swaziland, Gambia, on the matters connected with accountancy, finance, and management training. Sir has wrote 4 books on accountancy and taxation. He is visiting faculty at Department of Commerce and Management Studies at Calicut University and many other management institutes. Wrote regularly a weekly column on the capital market and economy in Malayalam Manorama. Regular speaker on economy, capital market, management in print media, TV, conferences, and panels. Regular participants in high-profile discussion on union budget. He's also the external examination of National Board of Accountants Auditors of Tanzania. And with this, I would like to introduce our special speaker for this session, who has vast experience in the topic, the smart investment in capital market, and we would be interested to get the inputs and your experience in the next 2 hours of the session. It's over to you, sir. Thank you, sir.
Thank you very much. I hope I am
Clearly audible?
Yes, sir.
Thank you for the nice words of introduction. It has been quite a long innings, more than 50 years as a chartered accountant. And when I see some of my associates in various meetings around, some of them tell me that their grandfather used to talk about.
Sir, it seems you're muted, sorry. Sorry.
Is it all right?
It's all right, sir.
Yeah, so it has been quite a long innings, and thank you for the nice words. I'm indeed delighted to be participating in this elite audience, talking about the capital markets in India. Needless to say, capital market is the toast of the season. Actually, COVID has ravaged the world, especially India, and there were dire predictions about what would happen to India. There were people who said India would take 10, 15 years to get vaccinated. But today, actually last week, we celebrated 100 crore vaccination, and it is a shining example of the new spirit of India. And I would say that capital market is the poster boy of the new spirit of India. I'm sure most of you know that India has been the best performing market in the world. We started this current year, April 1st, 2021, with 48,000 in Sensex, which is today around 60,000. And the Nifty was around 14,000 at the beginning of this accounting year. Today it is close to 18,000, a growth of about 27%, making it the best performing market in the world. Please remember that last year, March 24th, when the real impact of COVID struck the country, the Sensex fell down to below 26,000. And we are today at 60,000. The Nifty was around 7,600, and today it is 18,000. So undoubtedly, it has been an amazing run from the gloom that we saw about a year and a half back. Now, before going deeper into my topic of today, I'd like to just highlight a couple of macro themes which are very relevant to my topic. Some of these points were highlighted by Mr. Gurumurthy, whom I had the great pleasure of listening live a couple of days back when he addressed the Cochin Chamber of Commerce. I'm just borrowing 1 or 2 points from him. See, this 100 crore vaccination, for many, it is just a statistical number, but it is much more than that. Just think about it. There are only 2 or 3 countries in the world which could manufacture and even discover or originate vaccination, and India is one of them. Imagine if we did not have this. There are many countries in Africa, some of them very rich. I worked in a country called Botswana, which is one of the richest countries in the world. But they can't get vaccines because it's not available in the market. Imagine a situation in our country if we did not have this vaccine. But instead, we are already crossed 100 crores. So this has boosted the image of India worldwide. If we are to buy this from abroad, 1, the price would have been unaffordable. 2, the timing. To get 100 crore vaccines from abroad would have taken many years. And imagine what would have happened to the population in our country. So the fact that we could do this highlights our achievement, and the world is applauding India for that. Now, when we talk about capital market, to a large extent, it is perception in the minds of people. And that perception has taken a quantum leap thanks to the great strides that we made in our vaccination. The other aspect I want to highlight is this democracy, environment, and the thought leadership. The previous decade, the Western countries, the so-called developed advanced countries of the Western world, they supported China's autocracy instead of India's democracy. But now they realize that China is a threat, and it has become a sort of a security problem for the world. Now, the world needs a counterweight to China, and the only country which can replace China is India. There are countries like Vietnam.
So, one minute, sorry to interrupt, sir. This is Selva. Your microphone, there is some crackling noise, it seems. So can I just move a little bit, that is, your mic away from your body or something, so that...
I'm using earplugs. I mean,
yeah, the earplugs, right? That is when it is moved near to your, what do you call, shirt, there is a crackling noise. Can I just move a little bit more away from your thing? No, you don't need to move. Just move the microphone along a little bit from there. If that is...
Yeah, is it better now?
Yeah, it seems to be better. So you can just continue, sir. We'll see how it's it, because there is some crackling noise while you're speaking. Or else you can remove that once and you can have it as a open.
If needed, I can remove the microphone. I mean the ear thing.
Now it's clear, sir. Now it's clear. I hope you will see.
All right. Okay. Now I was talking about the how the world needs a counterweight to China, and the world is finding that India is a bedrock of stability in this very highly unstable world. And because of that, there is a major shift in the supply chain away from China, and world accepts India as the only country which can take on that burden and service the world. Take environmental issues. For India, it is a very natural thing because we live with the environment. We worship Bhuma Devi, we worship plants, we worship animals. It's part of our system. So with all these things, there is a thought leadership that is shifting in favor of India. Am I clear? Am I audible? I can see some other image here. Hello?
You're audible, sir. Just stopped.
Yeah. So because of all these things, you can see there is a record inflow of money flowing from abroad. In the completed year, the foreign institutions sent a record $37.6 billion into Indian markets. And the foreign direct investment into India was also the highest ever at $82 billion. So this is very, very important from our capital market point of view, because the perception abroad about India is changing so positive, which can be seen in this record inflow, even during these very difficult COVID times. That is a point to note. Let's talk about the potential for the market, the macroeconomy and the policy indicators which govern the flow into the markets. Nomura, the Japanese giant investment bank, in their India Business Resumption Index, they said the indices show all-time high as high-frequency indicators are pointing to a robust economic revival in India. They say the indices show all-time high approach towards India. Another institution, Jefferies, they say India may be on the cusp of another golden age, like the 2003-2010 period. 2003 to 2008, we saw the stock market index going up by 6-7 times from BSE Sensex, from about 3,000, it went up to 21,000, 6-7 times. They say it is on the cusp of another golden age, reminding the 2003-2008 period. That's what Jefferies says. Now, Morgan Stanley, they say the Indian market could more than double in 5 years. According to them, the profit to GDP, which is a very, very key indicator about the potential of the market, it is around 2% now. the profit of corporates as a percentage of the gross domestic product. They say it could reach up to 7% in the next 3 to 4 years. That means if the profits triple, you could imagine what could be the capital market, because everything said and done, the indices depend totally on the profitability of the corporates about which we are talking about. Our own Ramdev Agrawal, one of the leading analysts, the managing director with Motilal Oswal, he came out with a report which said the Sensex could cross 1 lakh in the next 5 years and 2 lakhs in the next 10 years. People were amazed at those large figures, but looking at the macro indicators, I don't think that's a pipe dream. That could very well be a reality. Let's go into some details of the macroeconomy. Take the corporate profitability. It was very lackluster. We had almost a lost decade, the 2011 to 2020. Nothing much happened in the capital market because the profitability was growing only at 0.4% during that decade. 2020, financial year 2020, was almost one of the lowest years of corporate profit to GDP. It was just 1%. Now, from 2020 to 22, we expect a growth of 50% in corporate profitability, and 22 to 24, we expect an yearly growth of 15%. So from an overall corporate profit to GDP of 1 to 2%, as Morgan Stanley also reported, we are likely to see a 6 to 7% in corporate profitability in the next 3-4 years. The last time it was around 7% corporate profit to GDP was in 2007, 2008. When you remember, the index crossed 20,000 for the first time. That moment is likely to come in another 3 to 4 years. So that is about profitability. Another indicator is the corporate leverage, which is a very important point here. It is at a cyclical low of 0.7%. The debt equity ratio for corporates today is 0.7 for 600 non-financial companies. Now, a low debt in balance sheet, what does it mean? We all know, we are accountants. A low debt in balance sheet would mean it is companies are getting ready for the next big boom in the economic cycle because their ability to borrow is much, much higher. We had many corporates which got into serious trouble in the last few years, which I don't want to go into at this time. But now the leverage has come down to historical lows. So it is about time that companies start expanding by borrowing and investing and give rise to the next boom. The contributing factor there is interest rate cycle. All of us know that in our lifetimes, we are seeing the lowest interest rate cycle. There are advertisements in TV talking about housing loan at 6.5% interest. I don't think we could imagine that interest rate in our younger days. We are seeing 10, 15, 20, 25% interest. Now it is available at 6.5%. Now that is understandable because there is so much of liquidity in the world. The world is awash in liquidity. As a Western governments and central banks all over the world, they did not want COVID to affect economic activity. So they injected a lot of money into the world economy, and that money lands up all over the world, especially into a high growth country like India. As many of you would be aware, there are 15 trillion dollars in the world bond markets, which are in negative interest rate. I find it difficult to accept a negative interest rate scenario, but that is real. You invest $100, After 5 years, you get $98 is something which I find it hard to believe, but that's the reality, my friends. $15 trillion at the last count in the world market, especially countries like Germany, Switzerland, Japan, Belgium, all these countries are in mostly negative interest rate. So this is a big, big advantage for India, which is very capital hungry, because there are so many huge developmental projects in India, which depends on inflow of capital from all over the world. So it cannot be a better time. Our interest rates are low, the world interest rates are much, much lower. As I mentioned earlier, India is a major recipient of foreign institutional investment as well as foreign direct investment. As mentioned earlier, we had a record inflow of 82 billion FDI last year. And last few years have been about $60 billion. So that's a very, very major positive for our markets. Now, the investor participation, that's another thing which all of you would have joined, all of you would have recently seen. Every month, almost 15 to 20 lakh new investor accounts are being opened in India. I'm told the last 12 months, almost 26 million new investors joined the market. Presently, we have about 7 to 8 crore investors in the country, making it about 5% or so. Out of that, maybe around 4% of the population may be active. And according to the BSC managing director, this number is expected to at least double in the next 3 to 4 years, making it about 15 crore investors. Imagine if compared to 2 years back, it is already more than doubled now. And from here, if the number of investors double again in the next 3 to 4 years, imagine the shape of the capital market. Earlier, we used to depend entirely on the fund flows from abroad for institutional investors, but today we no longer depend on them. We have our own internal sources. The assets under management in mutual funds, there are 41 mutual funds in India, and it has already crossed 37 trillion rupees. Mind you, it was 6 trillion in 2011. So almost a 6 times increase in the assets under management with mutual funds in India. The demographic dividend, our esteemed Prime Minister always talks about it. We are the only major economy in the world with a rising working age population. Countries like Japan, I'm sure most of you will be aware, have got more older people and very few working age population. So as years pass by, the whole world is going to depend on young working age population from India. Now, I would like to make a mention about the reforms and the policy developments in our country. Last few years, we have seen a very proactive government. My friends, I'm not talking politics here. I'm talking only economics and the markets here. From the market point of view, we have had a very, very proactive government in this country, especially in the last 2-3 years. We had the new telecom policy, which almost bailed out the third telecom operator, Vodafone Idea. Otherwise, they were thinking of closing down the operation, and it would have become a duopoly to the great loss of the consumer. Now, thanks to the new policy, the third company also will survive. We had the PLI scheme, the production linked incentive schemes in electricals, electronics, pharmaceutical, the mobile manufacturing, textiles, auto ancillaries, sector after sector. This production linked in this incentive scheme is a master stroke. Major companies from abroad, very large multinational companies from abroad, find it very attractive. That too at this time when many of these companies are thinking of moving over from China. And this scheme, they feel very, very attractive, which is like a magnet attracting these large companies to India. As you all know better than me, we had a very large corporate tax cut in 2019, a very drastic one. I don't think a cut like that we would have imagined as possible a few years back. The government has announced a very large asset monetization scheme. They're talking about 6 trillion rupees worth of assets, of the government assets, which are going to be in private hands for effective use. The Air India, we started hearing about privatization of Air India maybe decades back. But at last, it has happened. It has happened in such a transparent, acceptable manner that even the opposition parties don't feel like criticizing it, very surprisingly. And LIC IPO looks like it's going to happen in this accounting year itself. And I'm expecting a valuation of 10 lakh crores. And they're talking about a 10% divestment, which is 1 lakh crores. If it is increased over a period of time, that alone can wipe out our fiscal deficit. We are going to have BPCL, Container Corporation, all these are going to be privatized in the days to come. And now people believe it. Few years back, when the government talked about privatizing companies, nobody believed it because it never happened. But with Air India, the most difficult privatization, it has taken place in such a transparent manner. People are starting to believe, and the world is listening. LIC IPO is going to be an event by even world standards. And we have a very stable government, very stable policy making, and from SEBI's side, very strong risk management measures. From the stockbrokers' side, they find life very difficult because so many conditions and restrictions on the fund management of the clients and all. But from the client side, I can tell you, the Indian stock market is one of the safest in the world. And I don't think there is any case where a customer sells the shares and he can't get the money. So there have been tremendous progress in the reforms and the policy development side. The stock market does not exist in a vacuum. Stock market depends upon the reforms agenda of the government and how the policies of the government are being implemented. I just gave you quite a few examples of how serious the government is, which is why the capital market is taking it with both hands. Let me give you some idea on the macroeconomic trends in the country also, because stock market depends to a large extent on the macroeconomy. For foreign exchange, we have got a record. It has crossed 640 billion as on 15th October. The reserves are above 641 billion as compared to $1 billion we had some time back when we had to pledge our gold in to Bank of England and all that. It can finance almost 15 months of import, which is one of the best by any standards in the world. Take the exports this year. The first 6 months, April to September this year, the exports have crossed $197 billion. And we are going to cross the target hit for the year. The target for the year of export is 400 billion. And looks like we'll comfortably cross the target. These are not small things. And compared to last year, the exports are 57% above. Then you might say last year was an exception. What about the pre-COVID year? Compared to pre-COVID year, April to September 2019, our exports are 24% above that year, above that normal year. So that means we are performing exceptionally well in exports. The credit rating agency, international agency Moody's, have recently upgraded our sovereign credit rating to stable from negative. While I'm very happy to acknowledge that, please understand we are just above the investment grade. We are very, very close to. If something wrong happens in the economy, we could go into the junk grade. But for the time being, let us rejoice that they have found it acceptable, even in these very difficult COVID conditions, to upgrade our rating from negative to stable. The external debt to GDP is very reasonable at 21%. In 2015, it was 24%. That means we are improving on the external debt situation. We have a very stable balance of payments, current account situation. The rupee has been relatively very, very stable. We hear reports about Pakistan rupee going to 175 and all that, but our rupee has been fluctuating in 72, 73, 74, 75. It's a very small, narrow range for the last 1 or 2 years, even in this very difficult COVID conditions, when the world predicted that India would just wither away. I've seen such writings in the American and the British press, but I think we are standing solid like a rock. Look at the IPO boom. That's just unbelievable. Already 41 companies have raised 67,000 crores. And we are likely to cross 1 lakh crore for this year very comfortably. Zomato IPO, I'm sure some of you might have participated. Today, the Nykaa 5,300 crores IPO opened today. And the very first day, before the close of today, it has been oversubscribed. I've never seen such things before. Normally, the subscription from investors and all, the ordinary investors come second, third day. But the first day itself, Nykaa is already oversubscribed. And that's not a small issue. It's a 5,000 crore plus issue. Paytm is coming out with 18,300 crore, the largest the country has ever seen. Actually, they had planned, I think, around 17,000. But looking at the condition of the market, the confidence of the market, they found it better to increase it from 17,000 something to now 18,300 crore. That's opening in the next couple of days. So all these are the macroeconomic trends. They look very, very positive. Now, do I mean to say that everything is honky-dory? No, my friends, certainly not. Let me just quickly review the risk portion of that. There is a possibility of global tapering because there's liquidity, surplus liquidity in the world has been there for quite some time now. Many central banks have been talking about reducing the liquidity by withdrawing that, by slowly tapering away from the easy money policy. Now, if the surplus liquidity goes out, definitely there will be some outflow of money from India, which can definitely affect the markets. That is one possibility. And that could mean some increase in interest rate and attendant problems. But we have seen that during 2003 to 2008 phenomenon, interest rates went up by more than 3%, but the markets kept on going up because the sentiments were positive. So even if interest rates go up, normally when interest rate goes up, the capital market comes down. But when the sentiments are very positive and the macro trends are otherwise reasonably good, there are evidences in the past, like 2003-8 period, when interest rate kept on going up, but still the markets continue to grow. That's a sentiment. So no serious worry there, as I understand at this moment. Inflation has become a reality. If you analyze the statements brought in by the various corporates, you will see the clear signs of inflation taking a bite. 2 days back, we had the iconic company Asian Paints reporting results, the quarterly result. It was up 30%. The turnover was up 30%, but their EBITDA went down by 30%. It is, I think, almost the first time in 50 years that Asian Paints talked about an EBITDA loss of 30%. That is simply the inflation biting into the profitability. A new COVID outbreak. I'm talking about the possible risk to the otherwise very rosy scenario. A new COVID outbreak. Nobody knows what is in store. Countries like the UK and Brazil, which had brought COVID under reasonable control, are now reporting some possible issues with new variants. That is, nobody can predict that. But the way it looks, things are under reasonable control in India, except possibly for my state of Kerala, where the numbers of COVID patients are almost 50% of all India. But the interesting point to note here is that despite this reasonably large number in the state of Kerala, there is no panic in the sense that the hospital system in the country is ready to cope up with even a bigger outbreak because we have learned our lessons. So a new variant of COVID could derail some of our expectations, but looks like the country is better geared even to face eventualities. The other possible risk is a global political instability. America is talking about defending Taiwan, and China says don't play around in Taiwan. So like that, there could be global political issues coming up, which can derail growth. Otherwise, the world economy is growing in one of the highest rates that we found in recent years. And one more point on the risk side I would like to mention is what we in the market call it as the Warren Buffett indicator. Warren Buffett, as all of you know, is the world's best known investor. And all his words, his speeches, his annual letter is referred to as the Bhagavad Gita or the Bible by all investors all over the world. I go through that every year because it contains so much of pearls of wisdom, which you cannot find anywhere else in the world. According to Warren Buffett, the best indicator whether the markets are overheated is a comparison between the market cap and the GDP. So long as the market cap is below GDP, according to him, it's just a rough and ready indicator. There are so many other factors which has to go into a decision making, but a rough and ready indicator is a market cap with GDP. In March last year, at the peak of COVID, when the market collapsed, the market cap with GDP was close to 50%. The market cap was half of our GDP. But today the markets have gone up and it is 120% of GDP. The GDP is around $3 trillion in India, and the market cap, yesterday's figure, was around $3.6 trillion. So that means the market cap with GDP is about 120%, according to Buffett indicator, slightly on the higher side, but just only an indicator. I don't think there is room for any worry on that account. If you look at the US figure, the market cap is $50 trillion and the GDP is 22 trillion. That means the market cap with GDP is around 218%. We are at 120%. I don't think there is any room for it. Now that we have gone through the background figures and the potential for the market and all, let me take you through the sectors in the various sectors for investment in the market. So there are various sectors in the market, and I just want to quickly take you through some of the key sectors which investors look at for investment. The two natural sectors for India are IT and pharma. As everyone in the world knows, Indian IT is the world cannot exist without, world cannot survive without Indian IT professionals. You take any top company in the world, in America or anywhere, they are run by Indian professionals. And India provides substantially large number. We produce so much of IT professionals. The IT export from India last year crossed $148 billion. The performance of IT companies, especially during COVID, because the importance of IT was highlighted during this period when people had to work from home, companies have shot up in value. Almost every IT company has doubled or tripled in value. You look at the mid-tier companies like this Mindtree, Emphasis, Persistent, or some of these companies, they've gone up by 4, 5, 6, 7 times in the last 1 to 1.5 years. IT has changed the image about India all over the world. When I, as a youngster in the early 70s, went abroad and worked in a number of countries. I had the good fortune of working in about half a dozen countries. The image of India, I could remember very well. We had to be so defensive in our whole image. We had to work very hard to reach a zero figure and then work to become a positive figure. But today, thanks mainly to the IT prowess of India, many countries consider Indians to be the brightest people in the world. So I'm sure all of you would have experienced that. So IT is a natural sector for investment. I just want to highlight one figure on IT of company Infosys, which came out with IPO in 1993 at 95 rupees. And some of you might remember the issue was undersubscribed. There were not enough subscribers at 95 rupees. But if you were one of the lucky person to buy that 100 share at 95, investing 9,500 rupees. Today, without you doing anything, this 100 shares is today 1,02,400 shares. About 8 bonus issues, splits, all these things put together, 100 has become 1,02,400, and at today's price of 1,700 rupees, it is 17.4 crores. That means it has grown 18,300 times, not percent, 18,300 times. Now, somebody asked this question when I was mentioning this in a meeting. Sir, is there anybody who has held that share from that time onwards to this time? I told yes, one of my customers, because I was in broking at the time. One of my customers bought 200 shares and he refused to sell. Today he has 2,04,800 shares. I know his DP account. So there are people who do that, but most of us buy and sell it. But the money in the market is only if you hold the shares. I don't have to talk about IT. That's something which the whole world applauds, acknowledges, whole world knows India's IT power. Pharma is the other natural sector for India. It is because, we have, the world considers India as having some special skill in this complex chemistry. And the world prefers to call India as a pharmacy of the world. Now, recently, the AIS investor Rakesh Junjunwala met the Prime Minister of India and made a presentation. And one of the slides said, of course, that's figure we know, but I'm just quoting him. One of his slides said, in America, 45% of the drugs consumed by Americans are made by India. Not by value, but by volume. 45% of the drugs sold in America is made in India. That's what he says. Now, the sector pharmaceutical is a very wide and varied sector. There are original companies doing original research like Syngene, Dr. Reddy's, quite a few companies. There are companies which go into API manufacturing. There are hospitals, there are diagnostics, the whole series of companies in pharmaceutical. And this is another sector where India is said to be having an exceptional advantage. So you look at any sector portfolios or leading investors, you will find a good number of IT and pharma companies. The other sector which investors look at very closely is the financials. Now, financials went through a very difficult period because of the non-performing asset problem. But I'm very happy to, as a banker, as I have been involved in a bank for quite some time, we have seen there are predictions that it could go out of control due to the COVID problems and the restrictions imposed by the government, lockdown and all those things. Some of us were quite afraid of what could result. But now that COVID is practically behind us, now banks are looking at their figures very closely. Most of the banks which have come out and reported their figures have reported much, much improved figures. So the bad loans nightmare is practically behind us. And the PSU banks, public sector banks, which even today control about 60-65% of the entire banking assets in this country, they were in very bad shape for the last 7-8 years, thanks to the NPA problem. But due to recapitalization and very aggressive writing off of bad loans and all that, today, slowly, steadily, the public sector banks are coming out of the nightmare of NPAs. So banking sector is one sector which holds tremendous potential, especially as it's one of the fastest growing economy in the world. And any growth has to be backed by credit given from the banks. Just to give you a couple of figures about banks, HDFC Bank, many consider it as the world's best run bank. It may not be the largest, but in valuation it is one of the highest priced bank in the world. It came out with an IPO in 1995 at 10 rupees. And if you could get 100 shares at that time, investing a huge amount of 1,000 rupees, today you'd be having 1,000 share at 1,650. It is worth 1,650 times. that is HDFC Bank. Kotak Bank came out with an IPO in 2003 at 32 rupees. If you are good enough to, if you're lucky enough rather to buy 100 shares, it is worth 44 lakhs today, 4,400 times. You don't have to go to HDFC Bank or Kotak Bank. We have a company here. I was one of the directors of the company earlier, Manappuram Finance. If you could buy 100 shares in 2007, just about 13, 14 years back, investing 1,000 rupees, today it is 8.5 lakhs. It is 850 times. So that is how the banking system has performed. It went through difficult times, especially the public sector banks. But today, when I talk to some of the heads of these banks, they're fairly confident saying that this scare of NPAs, scare of COVID is practically behind them. Not fully out, but they have survived that, and banking is going to be on a roll. You can see that in the banking index as well. The NSE banking index is almost at all-time highs. Now, the other aspect in financial sector is the financial services. You go back 10, 15 years, I don't think we had a financial services industry here at all, worth its name. Insurance, we had only LIC, which is in the government sector. But today, we have quite a number of insurance companies which are in the listed domain, which means you and I can buy it. There are 4 or 5 asset management companies which are listed in the last 1 or 2 years. All these came out to our listing only the last 2 or 3 years. We have depository. One depository is already listed. And all these new financial services industry shares, like insurance company, asset management, depository and all, they hold very high potential because they are practically new. You take each one of them, insurance, the lowest number of Indians are insured. You compare with any country in the world, we are the lowest number of insured population. You take asset management company, compared to the percentages of assets under management in AMCs in foreign countries, we are just starting the journey. So the potential is so high. So in all these new generation financial service companies, the potential seems to be pretty high because they are just at their infancy. The other sector I want to talk about is the housing cycle. The housing companies. Housing companies encompass the housing finance companies, the real estate companies, housing materials companies. Now, there is a big study which I had the privilege to go through, which analyzed data available from 1996 to 97 till date. Last 25 years data was analyzed. They are able to find a very clear housing cycle in India, which lasts 6 to 8 years of upcycle, followed by a 6 to 8 years of down cycle. So cyclical. Everywhere in the world, it is cyclical housing, but I think it is much more evident in this country. Now, what is the reason for my mention it here? Last 6-7 years, 2013 to 2020, we had a prolonged down cycle in real estate. Not a single real estate company or housing finance company, none of them performed because it was in a depressed state. Unless the prices keep going up and all that, nobody wants to buy. So that was the phase. 2021 is our first year the experts, the analysts are seeing an upcycle in both price of house as well as in volume. The number of houses being sold, or you can put it the other way, the unsold inventory, which was very high, is going down steadily. So it is just the start of this cycle. So from experience, we can say a housing cycle starts for, it goes on for 6 to 8 years. So we are just in the first year. So maybe there is great potential for everything related to housing, the real estate companies, housing finance companies, companies making housing materials. Just to give you an example, the iconic company Asian Paints That is a unique company in the world. I'm sure some of you might have noticed that. In the last 50 years, it has grown consistently 20% every year, consistently. Its IPO was in 1982 for 23 rupees. I was one of the subscribers. I was abroad at that time. I subscribed, I got 200 shares. But of course, I didn't keep them for too long. If you had kept those 100 shares in IPO, today it is 2.4 crores. The growth is 10,000 times from the time of IPO. So last few years, housing companies went through a difficult period, but I think the time has come again for those companies to perform. And it is supported by the affordability. There's an affordability index, which is computed based on the average income of an average person, average employee, and the cost of housing. They say the affordability index is the best in the last 2 decades now. And there's a huge pent-up demand, right? The other industry I want to talk about is specialty chemicals.
Now you unmute yourself, so you should be able to.
Yeah.
Thank you. Now you're audible.
Am I audible now?
Yes, sir. Loud and clear.
Okay. Sorry for that. I don't know what happened really. I do not know whether it's a problem
The
on this
internet
side.
connection might have got.
Yeah, from whatever. Okay. Yeah, I was talking about specialty chemicals, and this China plus one factor is the main thing that plays out in specialty chemicals, because China is a dominant manufacturer and the whole world wants an alternative to China. And many countries are trying to be that, but the size and scale of requirement and the expert knowledge and of deep complex chemistry, I think only India can be a proper substitute for that. So the potential for here is so huge. Companies in this sector like Deepak Nitrate or many of those companies, they have become multi-baggers in the last few years. Pidilite and many of these companies have become the favorite of the investors. The other sector I just want to briefly touch upon is FMCG and durables, fast-moving consumer goods and durables. There's a rising, aspiring middle class in India, which is one of the largest number in the world, and they all need these goods. So the potential is an evergreen sector, which is in the portfolio of every person. Of course, I don't have to mention much about it. I just want to touch upon the digital shares, which are become the talk of the town these days. I understand that in the next 3 to 4 years, the digital economy shares in India will cross $1 trillion US. The digital economy shares. The first big one in that was the Zomato share. Of course, we had one or two earlier, like India Mart or some of those shares. But the real big one is Zomato. And now today, Nykaa came out for listing, and the very first day it has been oversubscribed, 5,351 crores. Now Paytm is coming out with 18,300 crore issue. So the market cap of these companies in the next 3-4 years is likely to cross $1 trillion. That is the size of the digital economy, which is going to propel Indian capital market into one of the largest and the biggest in the world. We are already about 4, 5, or 6 in the world. The way it is progressing, I think the time is not far when we become number 3 or number 4 in the world in the next 3-4 years. I would like to go to the concluding part now, and I would like to just share my thoughts on the shape of things to come in the markets in the next few minutes. It's unpredictability. That is one factor which is bothering everybody. That is important when markets are at very high. When markets are very low, it is a no-brainer to invest and make money. But when the markets have gone up, the question is in everybody's mind, what is in store for the future? Now, the one factor that comes out these days is the high level of unpredictability. As you might have seen, this major company from China called Alibaba, in the last 1 year, since the time its founder, Jack Ma, made a statement criticizing the government of China for some political issues, he came out with some frank statements. In the last 1 year, Alibaba has lost a market cap of $344 billion. Its market cap has collapsed by more than $300 billion. Just imagine a company. In India, we don't have any company of that market size. Even Reliance is only about 200 billion. The collapse of Alibaba is more than $340 billion. Just imagine. On the other side, Elon Musk, the founder of this electric car, Tesla, in 1 day, 2 days back, in 1 day, his market cap, his own personal wealth went up by $32 billion. $32 billion up in 1 day. So much for unpredictability in the market. Now, markets have gone up by more than 120% in the last 1.5 years. What is likely to happen in the future? I am one, having been in this market for the last maybe 4 decades, I would say a correction is very much likely. But we have been waiting for it. Last 1.5 years, we have been talking from 26,000, when it went to 30,000, people talked about 35,000, 40,000, 45,000. Every time people corrected, but it has not corrected at all. In the last about couple of weeks, there has been a minor correction. Today, the BSE Sensex collapsed by about 1,100 points. But even then, you look at the index, from its high, it has corrected less than 5%. I don't think there has been any time in our market history when market went up more than 120% in 1.5 years without a less than 5% correction in between. I don't think there has ever been a period. So a correction is definitely expected, no doubt about it. Now, that is on the index. Somehow they have been managing the index. What about mid and small caps? The small caps and mid caps, which shot up more than the major indices, they have gone up by almost 150% from their low. There has been correction, especially in the last, if you take last 1 month, many shares, mid and small caps, have corrected between 10 to 40%. Very popular shares, the fancy shares like IRCTC, it touched 6,400 rupees. Yesterday, it was 4,000. CAMS, another very popular share, it crossed 4,000 rupees. In last 2 weeks, it has gone below 3,000 rupees. India Mart, the poster boy of the new generation industries, B2B and things like that, it went to 9,600 a month back. Today it is 7,000. So small and mid caps have been correcting 10, 20, 30, 40% regularly. But the large shares, you talk about the HDFCs or the Kotak Bank or Reliance, and some of these things, they have not been correcting. I expect definitely a correction. Today, you could see something, a shape of things to come somewhat. But I'm anticipating that. But let me tell you, with all my 40 years experience in the market, you can never time the market. If you say, I will invest after so much correction, it may happen, it may not happen. All the experts in the market, they would tell you that you can never successfully time the market. And an expert has said, I think it's John Templeton also, the best time to invest in the market is when you have the money. That's what the experts say. But with a market cap of 265 trillion rupees, Indian market is now worth $3.6 trillion, population of 1.4 billion, a GDP of 3 trillion, and a purchasing power parity GDP of over 10 trillion. In purchasing power parity, India is number 3 country in the world. After China, US, India is a 3rd country in the world. This 3.6 trillion market cap, 3 trillion GDP. These are not small figures. We are no longer a banana republic. We were never one, but in figures we were very small. But today it is a country to reckon with. The way the digital economy in India is progressing in financial services, in fintech, India is leading the world. India is a top in the world. My daughters in America, they tell me that the type of things that we do in India, they are not able to do in America. That's what they keep telling me whenever they call me every week. So India has reached a size, a critical mass, where the world has to take note of what is happening in India. China's aggression, their political, the way they are creating trouble for the whole world, every attention is getting focused into India as an alternative to China, as a very dependable economy, as a very stable economy with a very high quality regulatory framework like Reserve Bank of India, the SEBI, and all the way they function. The world is taking note of all these things. The way we manage the COVID crisis, all these are being talked about in world circles, except in the politically motivated newspaper reports that you find in Washington Post or New York Times. You ignore them, or even the London Economist, you can ignore them. The people, the policy makers in major Western countries have taken note of India as a very stable, reliable economy, of a critical mass size. I expect the next 3 to 4 years as a time for the capital market. The decade of 2010 to 2020, very few people in the market made money. But I'm reasonably confident that after a minor correction is part of the market. If anybody thinks the market has to go up continuously, no deal, don't come to the market. So correction has to be there. As I said earlier, small and mid caps are correcting, but we need a correction in indices also, but don't wait for correction. The only advice I can say is don't invest all your money. You can keep some money with you for a correction, but don't wait for that. So subject to a correction, one should not get flustered by a 5 to 10% correction, which is part of any market phenomenon. I would say the next 3 to 4 years belongs to India, and there is a lot of activity going to be. Look at all the macroeconomic indicators and all the reports of leading investment banks around the world. Every one of them is extremely bullish on India. So I think our time in the market has come, and I hope each and every person, investor, will get advantage out of that. I think with these words, let me, for the time being, stop here. Possibly, if I could, if anybody's wanting to answer some questions, I'll be very happy to answer them based on my understanding of the market. Thank you very much.
So I'll share my screen, so I have some questions. Also, there are questions in the chat box also.
Right.
I will share my screen. In the meanwhile, if there is any chat also, you can. These are the questions that came up in chat only. Rest will take it up in chat box.
Okay, yes, there's a general talk in the markets are overheated now. Given the profitability of companies, one can expect a drop in valuation. I would hello, am I audible?
Yes, you're audible. Please continue.
Yeah. I would definitely agree with that comment that markets, I wouldn't call it overheated. I would only say that markets have not corrected. Correction is a normal market phenomenon. It has got to be there. As I mentioned, small and mid caps are correcting, but the large caps, the HDFCs of the world or the Reliances of the world or many of those big names, they are not correcting. There has got to be I would fully agree with you, but I would not worry about it. I would keep investing. Of course, keep some money on the sidelines to take advantage of the normal market phenomenon of correction. The other observation is we are seeing small mid-cap companies growth grooming while large cap is slowing down. It's a signal for any future change. It's a good strategy to withdraw from current level and accumulate cash now to enable future investment. I would always say that when you get a substantial profit, take for example a share like Persistent, a very popular mid-cap IT share. It was at 500 rupees 1.5 years back. Now I think it is close to maybe 4,000 rupees, 3,500 rupees. In such shares, I would say it's a good idea to sell a small portion of that. A good share, you should never exit fully. Keep some money out of that, because anything that has gone up by 400 to 500% has to correct a bit. So from that outlook, it's good to keep some money. Personally, when the index crossed 60,000, that was about 3 weeks back, I booked 10% of my portfolio. I sold 10% of the portfolio, which I have put in my SB account. That I would invest only when the market corrects a bit more. So that's a good idea. Outlook for oil marketing companies. Oil marketing companies, they are good dividend plays in this country. But I doubt with the type of government policies and all, whether they could be big wealth creators. I have my doubts. But you will never lose from them, because the dividend returns itself is much more than a bank fixed deposit from them. And they are looking at the valuation, they are not very high. So they could be steady performing companies, not multi-baggers. That's my feeling. How much correction is the norm? I would say a market has to correct between 5 to 10% after a substantial raise. It has never happened in the last 18 months. If you include today's figure, today it went down by 1,150 points Sensex. I think just corrected somewhat close to 5%, which is a decent beginning. But there could be some more way down. But always remember, it's a very difficult call. Waiting for the correction and then investing is a difficult call. But I would personally recommend that. Although the experts have different view, I would say when the market goes up very substantially, you should book a bit and then keep the money with you. I subscribe to that school of thought. What is the outlook for auto sector given the push for electric technology? What about auto component stock? Yes, this electric vehicle is a very, very deciding factor. And the auto companies, you have to be very, very careful. But the biggest problem in the last few months have been this problem of these semiconductors, the chips. And today I have heard from the commentaries that the chip problem could last for more than 6 months, maybe even into 1 year. That is a big elephant in the room, because that is something without the chips making the modern cars, especially the luxury cars where the companies make more money, that could be a bit of an issue. So I think that sector has got tremendous potential, because there is a revenge buying and the increased salary levels, the increase in the GDP and all will definitely give rise to a bigger demand for that. So I think it's a sector too with a potential, but you should be on your guard. How to safeguard during downturn? Yes, when you make very substantial profits, I would say book a small portion of that. Don't exit any good share completely. Even if you have made a 10 bagger, 20 bagger, don't exit a share fully. A partial profit booking is in order so that you can enter the new generation companies or the same company on a correction. For example, Asian Paints went to 3,500 rupees. Then it fell down to 2,900. So if you had sold around 3,400, 3,450, probably you could have got back. That could be a good strategy. If you have 1,000 shares, sell 100, 200 shares. Once your target profit has been reached, sell a part of that, keep that money. You can either invest the same company if it comes down, or else in new generation companies, because India is seeing a flood of high quality, totally new type of industries. I mentioned about the financial services sector, like the insurance companies, the depository companies, ANC companies. We didn't have any of them a few years back. And they hold such high potential. Nobody would have new money to invest all the time. So when you get substantial profits in one company, do partial booking and invest in those companies with great potential. What is an index fund and how does it work? Index fund is a very nice way of passive investing. I have some of my good friends and customers who just asked me to put it in index fund, because their argument is nobody is able to beat an index. This is an argument which holds some good. I don't fully subscribe to that, but if you examine history, it's very difficult to beat an index fund, because index keeps on revising. Companies which go out of fashion are removed from the index, and new generation companies which fit the bill are included in the index. So if you simply go by the major mutual funds like Nippon and all those, they offer index funds. So if you invest in index fund, you are, without your knowledge, you are participating in the right type of companies. Companies which matter, companies which go out of fashion are removed from the index, so it won't be in your fund. Automatically, you are going for the in thing in the market. So that holds some water. There are many experts in the market who advocate index fund investing. You do nothing, just buy the index. But if you have a knack of picking up shares, if you have some interest in studying the market, especially our members who understand, who can read the balance sheet and all, possibly I have been consistently able to beat the index by a good margin. So I have not invested in index fund, but I can understand somebody who may not have the time or inclination to do the research. I think index fund is a nice way of participating in the growing capital market sector without too much of extra work. What is your advice on average losses by investing at lower levels or exiting from the company, investing in new company? That's an interesting question. I have a very clear view on that. If you are a trader, never average a loss. And never average something which, after buying something, if it has gone down, don't touch that if you are a trader. If you are a hardcore investor, that too, if you are a value investor, that means somebody who studies the balance sheet, who studies the macro economy, who right to see what is the right value for a share and then buy it below that right value of the share, as recommended by Warren Buffett and people of that genre. In such case, suppose you bought a high quality share. Suppose take for example, say HDFC Bank. Suppose you buy it at say 1,600. And it goes down by, say, 5%, 10% due to some market phenomenon. Nothing wrong in averaging it. So long as you have made your homework before buying a share, you studied this share and you bought the share at a particular price, knowing that it is good value. If you have done those homework and that share, due to whatever market phenomenon, some macro changes or like a COVID or something, some external event happens or something like that, if the price goes down, there is nothing wrong in averaging that. But never average a loss-making share if you are a trader. Is it better to invest in stocks directly or through mutual funds? My view is very clear. I invest in mutual funds just to benchmark myself. I am passionate about the shares and the market, the functioning of the market. I study the world stock markets, the world economy. Sorry, I'm passionate about it. So because of that, I invest directly in the stocks. If you have that passion for that, if you have that time, inclination, interest, I would say buy those shares directly. If you don't have that, mutual funds, because mutual funds in India especially are very highly regulated. There have been rarely a case of corporate governance issue in any of the good mutual funds. They are very highly regulated by SEBI as well as AMFI. So they perform quite well. So if you don't have the time, inclination or passion, but still want to participate in the growth of the Indian economy, go for mutual funds. A strategy for somebody who has some time to work on the markets and all will be put most of your money into buy directly and have some investment into mutual funds. In my book on the stock market wisdom, which I wrote last year, I have compared when exactly you should go for mutual funds. Why you should. Mutual funds sometimes have some extra advantage. They get firm allotment, which you and I cannot get. For a high profile share, there is some advanced selling into institutions before they issue it to the public. So the mutual funds get directly allotment. That's an advantage which only they get, which you and I as investor cannot get. And sometimes they get their research could be much more relevant than what you and I can. So they definitely have an advantage. So some portion, maybe 10, 20%, even if you are a passionate investor into mutual fund, is advisable. If you don't have the time, then there is no choice really. Which industries we can expect growth for the next 3 to 4 years? A specialty chemical, according to me, is the one big industry you could look at very seriously. They have gone up in the last 2 years very much because this China plus one theme has been very much in vogue in the last maybe 2, 3 years. And even a minor shift from China, a 5% shift from China could mean Indian specialty chemical industry could double or triple. That is, India is such a small country with such great advantage in this industry. China has been dominating, but that is likely to reduce because the world is looking for an option. So I find that industry having some of the highest potential. Then again, the financial sector, the banking sector, they have not gone anywhere in the last few years. I can tell you about a bank in my state, a federal bank, a favorite of the investor. They collected 2,500 crores from foreign institutions in 2016 August. 2016 August, 5 years back, 2,500 crores from foreign institutions at 116 rupees. After 5 years, it has still not reached that figure. And I can tell you that bank is very well managed. So banks, I feel many of them are very much underpriced. So banks, good private sector banks, and of late, the PSU banks. PSU banks have been battered so badly in the market. It's unbelievable the price at which high quality, good PSU banks were selling. They had problems with NPA, but some of them are doing quite well. I would say a bank like Indian Bank or Canara Bank, State Bank of India, undoubtedly. They're doing quite well, and they're generally very underpriced, although in the last 2-3 months, they have doubled in value. State Bank of India has almost gone up by about 2.5 times in the last 6 months. So they have gone up in value, but I still feel there is value left in PSU banks and good private sector banks, Speciality Chemicals. Housing cycle, as I mentioned, I dwelt at length on housing sector because that is one information many people may not have. The experience of the last 7-8 years have been very, very bad. Nobody made money by investing in housing companies. But experts are unanimous, the research houses are unanimous that a new big housing cycle is starting, and it's the first year. So it will play out for the next 3-4 years. So that may be another interesting area to invest. Can you suggest a good book on options? Yes, there are 2-3 interesting books in my library. Possibly I could write to the institute, and possibly you could. I'm not able to remember the names directly. There are 2-3 interesting books, simple, very nice books, which give a good idea of how to do options. And while on options, let me tell you, it's a very good idea to do options trade in limited doses after studying the thing, because that gives you a sort of a passive income, about say 1 to 2% of your invested a month without any risk. That has to be done very carefully. So what is your view on the banking sector in the coming days? My view on banking sector is extremely positive, very, very positive. The real valuation in banking sector is yet to be found out. Last few months, banks, they did not participate in the initial boom after COVID because people were worried. What will be the shape of banks? What will be the impact of the COVID crisis? Because many people may have lost jobs, many small businesses have folded up. So people were worried. Even the couple of banks where I am closely associated, when I talked to the managing director, they were worried 6 months back. But when I talk to them now, they say they seem to be much more confident. They feel that the worst is very clearly behind. And even if there is a third unexpected wave, they feel things may not be too bad. It will be very much manageable. And major banks like ICAI Bank and HDFC and all, they have created such substantial buffer reserves, which can very easily withstand another unexpected bout of COVID. So banking shares well managed private sector banks, as well as the leading 3-4 public sector banks. I feel the potential is pretty good. I think those were the questions which I could take up. And
yes, sir. Over to you, sir.
Yes, sir. Thank you for your wonderful detailed explanation, sir. Before we propose the vote of thanks, on behalf of the seminar committee, the 53rd Regional Conference Committee, I would like all the members to register for the upcoming 53rd Regional Conference of ICAI at Lee Meridian, Coimbatore on 19th and 20th of November. It's both virtual and physical meeting is available according to your convenience. According to your convenience, you can get registered yourself. And over to there are a few announcements from the SIRC. I would like them to announce it, sir.
Yes, sir. Thank you so much. So after registration, you'll be like getting Affordability software, which is like with 10 user interface, worth of rupees 8,650 is like 1 year free subscription for all the delegates who are like registering virtual come physical. So both will be like getting the software free of cost, and then another payroll software and HRMS automation tool to maximize your revenue with less time and less cost. This is also free to all the delegates registering for the conference, and which is like complimentary from Grey HR lifetime subscription worth rupees 26,400 for the first year, and every year of rupees 16,444 worth of benefit to all the delegates who are like registering for 53rd Regional Conference. And these informations are like shared through mail. So members who are like really welcome for the 53rd Regional Conference and do register for it. We'll share the link in chat. Kindly do check it. Thank you, sir.
Again, on behalf of the Southern Indian Regional Council and the virtual CP program, Investor Awareness Program, I would like Anantharaman sir for giving us the tips and his experience. This shows your experience in the field, sir. And I think all the delegates who have been here for the past 1.5 hours would really have been benefited. And I think you have answered all the questions with detailing on why you are saying, and the next 3 years, what is the area in which we should all invest, which is going to be going to be a kickers for our thoughts. And with this, I would like to thank you for your valuable time and all the members for being with us for this 1.5 hour session, for this evening session. And once again, with a closing note, I request all the members to register for the 53rd Regional Council, which is a great event every year. Thank you, sir. Thank you all.
Thank you for
Thank you.
the opportunity. Bye.
Thank you, sir.